Welcome to the King of Business, the channel where we break down the most important concepts in the financial and business world. Today, we are going to talk about the S&P 500, one of the most influential stock indices in the world. What is the S&P 500, and why do experts like Warren Buffett recommend it so highly? We will explore its history, its significance, and some curious facts that you might not know. If you are interested in understanding how this index works and how it can impact your investment decisions, stay with us. Let's dive into the fascinating world of the S&P 500, revealing the mysteries of the unbreakable pillar of the global economy, vertical bar S&P 500. The S&P 500, short for Standard & Poor's 500, is a stock market index that includes 500 of the largest companies listed on U.S. stock exchanges, such as the New York Stock Exchange, NYSE, and the NASDAQ. It was created by the financial services company Standard & Poor's and is one of the most followed and referenced indices in the financial world. This index is a key indicator of stock performance in the U.S. market and is widely considered a reflection of the U.S. economy. The S&P 500 does not simply include the 500 largest companies by market capitalization, but also considers other criteria such as liquidity, domicile, stock price, trading volume, and sector classification. Companies in the S&P 500 represent approximately 80% of the available market capitalization in the U.S. market, making it a critical metric for analysts and investors. Why do experts like Warren Buffett recommend it? Diversification is one of the fundamental principles of investing, and the S&P 500 provides automatic diversification. Investing in the S&P 500 means investing in a wide range of industries and economic sectors, from technology and finance to healthcare and energy. This helps reduce the risk associated with investing in a single company or sector, as losses in one area can be offset by gains in another. For example, if tech stocks have a bad year, other sectors like healthcare or consumer staples may perform positively, balancing the investor's portfolio. Historically, the S&P 500 has offered an average annual return of 7 to 10% adjusted for inflation. This performance includes the reinvestment of dividends. Although there are years of losses and short-term volatility, it has proven to be a profitable investment in the long term. Since its inception, the S&P 500 has outperformed most actively managed funds, demonstrating the effectiveness of a passive investment strategy. This consistent long-term performance is one of the reasons Warren Buffett has repeatedly recommended individual investors to invest in index funds that follow the S&P 500. Investing in an index fund that follows the S&P 500 is a low-cost strategy compared to active investing. Index funds and ETFs that track the S&P 500 usually have very low management fees. Actively managed funds, on the other hand, often have much higher fees due to the costs associated with research and active portfolio management. These additional costs can significantly erode long-term returns. For this reason, index funds are an attractive option for investors looking to maximize their net returns efficiently. Investing in the S&P 500 allows investors to hold shares in some of the largest and most successful companies in the world, such as Apple, Microsoft, Amazon, and Alphabet, Google. These companies are leaders in their respective sectors and have demonstrated a track record of growth and profitability. Additionally, the inclusion of these companies in the S&P 500 is a sign of stability and reliability. Investors benefit from the continuous growth and innovation of these companies without having to select individual stocks, which can be complex and risky. Standard & Poor's created an index that included 233 companies. This was a precursor to the S&P 500 and provided a foundation for the creation of the modern index. Although this initial index was smaller and less representative, it established the methodology and framework that eventually led to the development of the S&P 500. The S&P 500 was launched in its current form, including 500 companies. This significant change provided a broader and more representative measure of the U.S. stock market. The inclusion of 500 companies allowed investors to gain a more comprehensive view of the market state and facilitated the use of the index as a benchmark to evaluate the performance of other investments. Vanguard launched the first index fund that tracks the S&P 500. This was an important milestone in investment history, as it provided investors with a simple and efficient way to invest in the stock market. Index funds have gained popularity since then due to their low cost and ability to replicate market performance accurately. The S&P 500 reached an all-time high during the dot-com bubble in the late 1990s and early 2000s. This period was marked by extreme speculation in technology companies, many of which did not have solid financial foundations. When the bubble burst, the S&P 500 experienced a significant decline, highlighting the inherent volatility of the market and the importance of diversification. The January effect is a theory suggesting that stock prices tend to rise more in January than in any other month. This trend has been historically observed in the S&P 500, particularly in the 1970s and 1980s. The theory holds that this increase is caused by investor behavior, selling stocks at the end of December to realize tax losses, and then buying again in January. Although the validity of the January effect has been debated and does not always manifest, it remains an interesting observation in market dynamics. It is often debated how much the S&P 500 actually reflects the real U.S. economy. While the index includes many of the largest and most successful companies, it does not necessarily reflect the state of small and medium-sized enterprises, which are crucial to the economy. Additionally, companies included in the S&P 500 are multinationals with global operations, meaning their performance can be influenced by international factors as much as the U.S. economy. The composition of the S&P 500 is not static. It changes regularly as some companies are removed and others are added. These decisions are made by the S&P 500 Committee, which evaluates factors such as market capitalization, liquidity, and sector representation. For example, in December 2020, Tesla was added to the index after meeting the necessary criteria, which was a significant event due to Tesla's large market capitalization. These changes reflect market evolution and can impact index funds and ETFs that follow the S&P 500, as they must adjust their portfolios to reflect the new composition. The S&P 500 has been a benchmark for a series of innovations in financial markets. The creation of financial derivatives such as futures and options on the S&P 500 has allowed investors and speculators to make bets on the index's movement without directly owning the underlying stocks. These products have added depth and liquidity to the market, but have also introduced new risks and complexities. Additionally, advances in financial technology have facilitated access to the S&P 500 through online investment platforms and mobile apps, democratizing investment and allowing a broader range of investors to participate in the market. Pension funds and sovereign wealth funds are large investors in the S&P 500. These funds manage enormous amounts of money and often invest a significant portion of their portfolios in S&P 500 index funds due to their stability and long-term performance. The constant demand from these institutional investors provides stability to the index, but it also means that their investment decisions can have a significant impact on the market. Changes in pension fund investment policies or movements of large sovereign wealth funds can influence the S&P 500's performance. Financial analysts and research firms often issue forecasts and recommendations on the S&P 500 based on various models and economic analyses. These forecasts can influence investor behavior and, in turn, the index's performance. Quarterly earnings reports, macroeconomic risk assessments, and economic growth projections are some of the tools analysts use to evaluate the S&P 500's future. However, the market can be unpredictable, and forecasts often turn out to be inaccurate, highlighting the uncertain and dynamic nature of the stock market. The S&P 500 is frequently used as a barometer of the U.S. economy's health. A rising market is generally interpreted as a sign of confidence in the economy, while a falling market can indicate economic problems. However, this relationship is not always direct. For example, stimulus programs and expansive monetary policies can boost the stock market even when the underlying economy faces significant challenges, as observed during the COVID-19 pandemic. This disconnect can lead to misinterpretations about the real state of the economy. Investors use a variety of strategies to invest in the S&P 500, adapting them to their goals and risk tolerance. Some of the most common strategies include investing in an S&P 500 index fund and holding the investment long-term, benefiting from compound growth. Investing a fixed amount of money at regular intervals, regardless of stock prices, to mitigate market volatility risk. Focusing on specific sectors within the S&P 500 that are considered to have growth potential, such as technology or healthcare. Using options and futures to protect against potential market declines. These strategies allow investors to participate in the S&P 500's growth while managing risks effectively. The S&P 500 is more than just a stock index. It is an essential tool for investors due to its diversification, historical performance, low cost, and access to major companies. The curious and mysterious facts surrounding the S&P 500 show the complexity and peculiarities of one of the world's most important financial indices. From its careful selection of companies to its ability to reflect and sometimes amplify economic trends, the S&P 500 remains a vital component of the global financial landscape. Warren Buffett and other experts recommend it because in the long term, it has proven to be one of the safest and most efficient ways to invest in the stock market, providing investors with balanced and diversified exposure to the U.S. economy. At the King of Business, we always strive to provide you with the best analysis and tools to make informed decisions. Today, by understanding the S&P 500, we've seen why it's considered a barometer of the U.S. economy and one of the most recommended investments by experts. From its diversification and historical performance to intriguing facts and its global impact, the S&P 500 is much more than just an index. If you enjoyed this video, don't forget to like, subscribe, and activate notifications so you don't miss any of our future episodes. Thank you for joining us, and see you next time.